You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker, Rob Carver, and me, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. If you're new to the show, let me start by saying welcome, with the hope that today's episode will trigger your curiosity and hunger for learning enough to check out the back catalog and listen to the past episodes that you may have missed, like my conversation last week with Mark, where we discussed topics like inflation, behavioral finance, and how firms need to retool for the AI revolution. A fascinating conversation that I hope you will check out if you have missed it. Good morning, Jerry. Good afternoon, Rob. Great to be back with you this week. How are you guys doing? How are things where you are?
It's nice here in Florida. It's early. I'm drinking my coffee, so I get in trouble tweeting late at night with the red wine, but I can still get in trouble with coffee as well, so we'll see what happens.
Yeah, I got in trouble for drinking too much coffee on an earlier episode as well, so I'm trying to ration myself. But it's really, really good to be here and I'm with Jerry as well, as this is the first time we've done it with the three of us, so I'm really excited.
Yes, it's the first time, and it's something that I think a lot of people have been waiting for with anticipation. So yes, I'm looking forward to this as well. In terms of a quick market wrap, the week as a whole, again, was driven by Fed news in the bond markets. Powell once again failed to address a number of pressing issues like T-bill yields, yield curve steepening, bond buying in his Wall Street Journal virtual press conference, which was held on Thursday. The 10-year note repo traded as low as minus 4%. Now, such a situation exists when short sellers aren't able to borrow the bonds to make delivery. Now, this is a situation that is not unlike what happened in GameStop last month, but there's a big difference because the Treasury will reopen something around 38 billion of the same 10-year note next week, so we shouldn't expect any significant short squeeze rally here. And lastly, we had the Minneapolis Fed President, Kashkari, who said that if real rates spike, it may warrant more easing. It's almost like if he doesn't quite understand that real rates usually rise when the economy is accelerating. But let's hope that he really does realize this. As mentioned before, perhaps the most important topic investors have to plan for right now is the potential shift for a change in the 40-year regime of deflation pressures and ever-falling interest rates to potentially a number of years ahead with inflationary pressures and also a shift in the interest rate cycle. Many investors have had their portfolio either knowingly or unknowingly set up for lower yields and have done really well in many years up until now. However, inflation is not going to look kindly on a portfolio like that, so I have a feeling that that is a topic that we will come back to on a regular basis on the podcast. But I want to start with you, Rob, today, since it's been a little while longer since you were here compared to Jerry. What stood out to you in the last few weeks? What's been going on in your portfolio?
Not great news, to be honest with you. I'll just give you some really quick numbers first, just for context, really. So if I look at the last week or so, then I'm down 2.4%. If I look at the time since I last sort of spoke to you guys, then I'm down about 2.6, so pretty similar. So year to date is minus 3.8. And it really is very much, particularly, not so much in the last week or so, but the sort of few weeks before that, it was all about the bonds, in particular in Eurodollars, where I had a reasonably sizable position. And when rates obviously sold off, that hurt me quite a lot. So that's probably where most of my losses were. In the last week, there's been a little bit of a rebound and made a little bit of money on Eurodollar. But of course, I've got a much smaller position now because, of course, you know, when the sell-off happened, due to the vol spiking and, of course, the trend reversing, I would have reduced my position dramatically. So I've only got a few Eurodollar contracts now, so I didn't make, you know, anywhere near as much money back as I lost. But, you know, that's trend following. That's the way it goes, I guess. But really across the board then, just a pretty mixed performance, to be honest. And nothing else really stands out. I think for me, at least, this month really has been all about the fixed income market, which For me, it's kind of interesting because, that's my background originally. So I've been watching all this stuff with some keen interest.
Yeah, maybe we'll dig into that also a little bit later. And what about you, Jerry? The last couple of weeks, anything that has stood out to you?
Stood out, I would say, certainly hitting short the bonds, bond futures. I added some bond ETFs to my portfolio, muni bonds, mortgage-backed, tips, high yield, junk, corporate. So one of those, the corporate ETF, got short. It's not as weak as all of the normal 10 years that I trade. I just trade the 10 years in all the different countries, not Korea. I think Rob tried to help me with Korea, but I can't trade Korea in the US. So anyways, that's what stood out. And withstanding the drawdowns in the LME, it's no fun. The drawdown in the currency positions, the longs versus the short dollar, that got worse as the week went on. And then the Bitcoin drawdown and then rally. I don't even look at Bitcoin. It's so outrageous every day. I just cross my fingers and hope it's still in an uptrend. So anyways, it's a lot of volatility and a lot of profit give back. I'm sure we're still up double digits for the year. It's just been an amazing run that simple breakout trend following has done well when finally the markets do well. So that's our fate. Is if they're great trends, I'll make some money. But I really need the markets to do all the work for me so I can just sit back and really do nothing.
And maybe just a quick question, Jerry, on follow-up on the ETF. How do you go short the ETFs if you're trading ETFs? How do you go short that if your signal turns?
We trade the stocks and the ETFs at IB, and we just go short just like we do. We had a short recently in Domino's Pizza. So you just have to look up on the IB website whether you can go short and what do they have enough shares for you to borrow.
Okay.
And we get our leverage at IB for the longs and the shorts stocks just as if it was a futures market. In short, no difference.
Yeah.
Just figure out the mechanics and do it.
Sure. No, okay. I get it. That's great. On our side, we had a positive week for the first week of March in both our trend following program and our volatility program. Trend following performance was mainly coming from two sectors, really, the energies and the stocks, both putting in a strong showing. Currencies were the most difficult for us, with the US dollar gaining some strength. And then we had soft and metals, where we also saw small corrections. And then grains managed to produce a small gain for us. But all in all, a small positive so far in the trend space. In the world of volatility, we did see a significant pickup in realized volatility this week, and the size of the daily moves in the S&P 500 also increased, of course. On Monday, for example, the VIX had a 4.6 points move lower from 27.95 to 23.35, with the S&P up 2.4%. And that's actually the largest one-day jump in more than 6 months. And all in all, our volatility strategy was able to extract a small profit from this change of scenery, so to speak, in the vol space. For my own trend following model portfolio, where I can be a little bit more granular, so to speak, it was a slight down week, down 22 basis points, which leaves the year-to-date return of 5.17%. Performance so far this month comes from the Group 2 models, up 0.65%. Group 1 and 3 are slightly down, 0.31 and 0.54 respectively for the month. Sector attributions this month, energy is doing the best, followed by grains, and the laggers this month so far are equities and base metals. And then if you look at the single markets, then it's really down to the energies, Brent, heating oil and crude doing well. Actually, also the yen did pretty well. And on the downside, we have the DAX, we have copper, we have Nikkei as the worst three markets this month. And finally, in terms of changes to the model this week, we did see the model exit some copper midweek. It tried to buy a bit of DAX for one of the faster reacting models. And then on Thursday, it exited a bit more copper and lead, as well as platinum. And on Friday, which was the busiest week with 7 trades, one of the models reversed its euro position and went short. It took some profits in British pounds and it went short the yen, as well as reducing its long Nikkei position. All in all, in terms of risk, the risk to stop moved in a little bit further. It's down to 8.24% if everything gets stopped out tomorrow, and that's down from 9.02% a week ago. About 14 trades all in all for the week, so nothing that's going to build up any sweat. Pretty easy to follow. Now, we have a few great questions coming in from Rene, Michael, Doogie, Gustavo. But before we go to those, I wanted to start out with a few points that Jerry had raised in our preparation for our conversation today. And of course, Rob, you may also have some of your points that you want to bring up. But I thought these were really interesting. And of course, some of it ties back to the whole point about making sure we got you two together, because there are some of these topics that you don't necessarily agree on. So that's going to be interesting. Now, the first thing that I remember was this conversation we had, I think back in November, closed equity versus open equity and total equity. And I wonder whether, Jerry, you might be able to set the scene a little bit, because it is one of those things where you and certainly also Moritz have one way of doing it, and Rob does it in a different way. So do you want to set the scene about where we want to start on this topic today?
Yeah, so this is one of my favorite topics, and so Rob did a good job against Moritz. So I gotta come in and see if two of us can't try to defeat poor old Rob on this subject. We're not going to change his mind, but I'm trying to distract him with all these birds I have flying around me this morning, and
he's not joking, guys. That there really are birds sitting on Jerry's shoulder at this moment.
Yes. True. They're eating my power cords, so I'm distracted by the one here. But anyways, I went back and listened to the November 27th podcast. Very good. I mean, probably my favorite podcast of the week to get to the question at the end of the show, but it was really good. And I downloaded the transcript. You can get the transcripts off of YouTube. So it was really good. And I think a lot of the kind of confusion or there is definitely going to be disagreement, but some of it is just based upon semantics and choosing the right words or better words. So anyways, I just thought I would cut to the chase and say that the term closed equity is kind of, it's not as clear as it could be, but just listening to what Rob had said, I would say that the point that I think Moritz and I are trying to make is that there is an obvious difference between closed equity and total equity or open trade equity. And I sum it up by saying, like, if you have a client who gives you $1 million to trade, and you immediately lose 100,000, you're down 10%. That's quite nerve-wracking for the client, and I see for me too. Versus the client is that same million is now 1.2 million, but you've experienced a 20% drawdown. So it was 1.4, now it's only 1.2. He is mark to market. I mean, we're embracing mark to market, and it's not a problem. But psychologically and maybe money management wise, to sort of feel a little bit better about being up 200,000 or 20%, but in the midst of a 20% drawdown, seems to be worthwhile and a reasonable way to look at things versus being down only 10%, but you're down to 900,000. So I think this initial investment that people make is CTAs and trend following does a very good job of defending that line, that initial investment, and saying, hey, we're going to take these small losses. We're going to be very conservative. We're going to risk 50 basis points and try not to have a drawdown on that initial investment. But the system, when we back tested it, it told us, hey, I'm going to do this, and this is what really works well. And it's a character and a feature of trend following that it does a fairly good job with one entry, one exit, and a stop loss, let's say, of defending that initial investment. But it says also that, hey, I'm not going to do the same thing with this 100-day breakout exit or 50-day breakout exit. I'm going to let those profits run. So when we get the results back from the back test, we're encouraged, but it's not something that I've come up with or Moritz has come up with. It is basically what the trend following model does on its own. It holds those losses for a month or two, and it holds those winners for 9 months to years sometimes, and lets those profits run and pays no attention to the volatility necessarily of those open trades.
Yeah, I mean, I think this is one of these things that is, as Jerry says, very much a discussion about semantics and what you mean by that. So I kind of agree that it's people hate it more if they give you money and the first thing you do is lose some of it, right? I mean, that, and they certainly feel better if you've already made them 100% and then the 10% loss comes. And so, if I was managing somebody else's money, that there might even be a case for possibly even varying your risk target as you make money. And actually, AHL, where I used to work, did actually have some funds that did this explicitly, and they had to do this because they were offering a guaranteed structure. So the way the guaranteed structure would work is, the investor gives you $100, you'd use $60 of that to buy a zero coupon bond with a certain maturity, and then you'd use the rest to trade futures with. And of course, because futures are very efficient margin-wise, that would be enough to give you the leverage and the size of positions you needed. But one consequence of that was we were trading as if we had $100 of capital, but really we only had 40. So we had to be extremely defensive of that 40. And if we started to dip into that, then we had to start cutting our positions very quickly, because, the kind of worst case scenario is you completely deplete that $40 and you're just left with a zero coupon bond, which provides the guarantee to the investor, of course. But you can't go any further than that because you've legally given them this guarantee. So that's one thing. But to me, that's not necessarily to do with whether you're treating open trades and closed trades differently, because you can build in that kind of psychological protection into your system regardless of how you're trading open and closed trades. You could, like I said, just do something really simple, which is just start with a very low risk target and then increase it gradually as you make money for your investor. So that's kind of, I can understand where you're coming from, but I'm not sure it has to do with open and closed equity, if I'm being completely honest. I mean, I do think there's definitely a kind of psychological human bias that people like to have profits banked, definitely. And that's one of the reasons why trend following works, right? Because we are willing to hang on to those trades as they make money rather than just cutting and running as soon as there's a small profit, right? That's the psychological bias that we're exploiting. So human beings do treat open and closed equity different. So to me, that's the reason why a system shouldn't do it, right? Why a system should not explicitly actually change the way it behaves depending on whether a particular position has made money or not. Now, if you actually look at how my system behaves and the way it behaves, it does exactly the same thing as Jerry's system does. It does hold on to winning trades for longer, and that's purely just a consequence of the way trend following works. But it does that without any explicit change in sort of behavioural state, regardless of whether the position is profitable or unprofitable. So we kind of get to the same place, perhaps through a different kind of thought process. But to me, it's not necessary to introduce this distinction between open and closed equity into my system to get the results that I want.
Yeah.
I was just going to say, Jerry, because I think I want to put a little bit of color here, not to necessarily raise the temperature, but I just want to make sure that, because I kind of remember the conversation, and I think some of the statements that were made back then was, we treat, and obviously Jerry wasn't there, but I think Moritz talked about treating open equity more liberally. And actually, in the conversation I had with Jerry a couple of weeks ago, which was really fascinating, Jerry explained, and I think it made a lot of sense, is how he changes his trade level differently than certainly we do on our side, where we adjust it, every month or every day and so on and so forth. So I think the debate is kind of, or the differences might be around those kind of levels. For example, as simply as, when to change your trade level. When do you recognize that now you're trading a larger account or a smaller account for that matter? Things like that, if I remember correctly.
Yeah, trade level definitely figures into it. But I just wanted to answer that one thing that Rob said. So I don't think that we're the ones introducing anything. Now, that's quite the opposite. It's like I said, with the cliche of building on that cliche of take small losses and let your profits run. We just buy the breakout on the entry, sell the breakout on the exit, and put a 50 basis point stop on the system and multiple ATRs from the entry price. So then the back test comes back and says, wow, I'm going to get out of profit sooner, and I'm going to let the profits run. I'm going to get out of losses sooner. I'm going to let the profits run, and look at all that volatility. And we're just like, Moritz and I are like, okay, that's the problem. We're doing a good job of defending the trade level, the initial investment. And then I just wanted to emphasize initial investment, but of course, closed equity is also incorporating the realized profits and losses. You can't forever sit there and say, well, it was a $1 million investment 5 years ago. No, we got to hold ourselves to a higher standard and add to that initial investment the realized profits and losses. No, far from it. It's not Moritz and I who are adding anything. We're just observing this simple cliche trend following. And I'm never for cliches. And if someone wants to say, I haven't seen this on Twitter yet, but if in response to take small losses and let your profits run, if some smart guy gets on there and says, no, let me show you where that's wrong. Okay, I'm down with that. Just let's look at your research. Let's look at your back test. But what's being added to the system is this vol target, this risk control, not from Moritz and I. We're saying, no, don't do that. You're treating open trade equity, you're trying to massage these open profits. There was an article yesterday about classic trend following versus hybrid trend following, a Hedge Nordic article. And one of the people in the article said, well, we don't have any classic people, but classic people would have held on to those LME positions last week. Yeah, they were very volatile. They're very scary. What if it goes back down to the 100-day low? Oh my God, it's going to be horrible. But the more hybrid, more evolved traders, they've figured out a way to have it both ways. Well, we do have a trailing stop that's at a 100-day low or whatever, but we also are not going to, we're going to take some off. We're going to add some more back on based upon the volatility possibly, or just this open trade. And so Moritz and I are saying, I know, you're right. If it works, it's much better. It's much better. But we're sort of saying, yeah, we're going to on purpose trade a worse system. It's going to look worse on the back test in order to not introduce more sample size problems and variables and parameters and things like that. So we understand everything about what people are doing, and we understand we have made a very unpopular choice. Another thing I tweeted was classical trend following people, they can complain about the vol targeting and the heavy duty risk management that gets in the way of the pure trade, but they have a lot less AUM than the more hybrid, the more evolved type traders.
Yeah, so we're getting more to the nub now of where we disagree, I think. So I guess the difference between us is you guys put a trade on of a certain size based on the risk that's there when the position's opened, and then you kind of leave it at that size. That's kind of a fair characterization? You're nodding, so that's fine.
Yes.
So the difference, of course, is that I'd say, well, actually, what I'm trying to do is continuously risk manage my position and my entire book, really, to have a certain level of risk. And what that involves, of course, means that if the risk of a position changes, and I already talked about it earlier, I said euro dollar, it got very much riskier, and that was one of the reasons why I reduced my position. Another reason was the trend started to reverse in the faster signals, and of course that would naturally reduce the position anyway, right? So yeah, it is a difference of, and I said this before, I don't think one way is better or worse, and I'm not sure about popular or unpopular. I don't think this is a popularity contest, but different ways of doing things, and they end up with different sort of risk characteristics. I mean, I gave a presentation last week actually about people who go even further than I do and actually adjust their book every single day so it has the same level of expected risk. And I personally, for me, that's going too far, because what you do when you do that, the main thing you lose is the fact that, say you're trend following, you've only got a small number of positions on, or the positions are very small in size because the trends aren't very strong. Well, the risk of your book is naturally going to be very low. To me, that's a good thing. Why would I want to be putting money on the table when the opportunities aren't there? But what these guys would do is actually then leverage up those positions so that they were hitting the same risk target every day. And to me, that doesn't make any sense. And so that's more what I'd call the kind of quant equity market neutral hedge fund kind of way of doing things. Whereas, as you say, Jerry, you're more the kind of the old school trend follower. And I guess I'm somewhere in the middle in that I do think, for me personally, I would like to do risk management of my open positions, but I'm not going to do that to the extent that I'm destroying the ability of the system to actually attenuate forecasts depending on whether there are opportunities there or not.
So how often would you do that, Rob?
Well, I mean, it's every time I trade, I'm looking at the current volatility of that market, and if necessary, some of my trading may be an adjustment as a result of that. So yeah, sorry, Jerry, you were going to say.
Yes, sir.
Yeah. So to state the obvious, of course, I think we all look at the volatility when we do a new trade. So when I was shorting corporate bond ETF, I looked at the ATR, plugged it into my equation, and determined the number of short position I should have in that ETF, and we do that. But then once we are done, and that ATR calculation, the position size, it only has one use, and that is to normalize the size of the losses. I want to lose 50 bips of my AUM on every trade. But other than that, it's going to double, triple, quadruple. It's going to get totally out of control. Tesla, gold, Bitcoin. What was the ATR in Bitcoin? Oh my gosh, it's crazy. But I would also say that, use another cliche, and that is you can't eliminate risk. It just goes somewhere else. So by eliminating, where does that risk go? Which I don't think it's risk. My risk was taking that small loss. Open trade equity, open trade profit, since it doesn't affect my trade level at all, it doesn't affect my initial investment at all, it's not risk. And it's volatility. But where does it go? And where it goes is, if you're going to manage the open trades, you're going to have smaller wins. Your winning trades are going to be smaller, which is fine. You're trading supposedly a more efficient system. So like all good money managers, as our system becomes better, the return and drawdown gets better, we can leverage it up and trade larger. So you supposedly have a superior and a better system with a higher Sharpe. And so you're going to trade larger. You have to trade larger to make the same amount of money, because you're not making as much money as the crazies like Moritz and me. And so your average loss is going to have to be larger. And so once again, you're attacking that trade level. You're attacking that closed equity, the initial investment. I'm risking 50 basis points to make the same rate of return. Someone who takes small profits, but it can be fine, I guess. But that's what it is. You're taking smaller profits. You're not letting your profits run. You may have to risk 60 or 70 basis points to make the same amount of money. And the defense is, well, the Sharpe is better. Maybe the system has more parameters and degrees of freedom, so you have to take that in consideration as well. Moritz and I are scaredy cats, and we're trading very conservatively. And at the end of the day, when it's all said and done, and we know the truth about should we have been so conservative and so fearful of adding more variables and parameters to our system, we may be wrong, but the only downside is we'll probably make the exact same amount of money, but we will have taken these unnecessary drawdowns. There was no reason to sit there with these open trades and let them slosh around and create all this havoc on a daily basis. It was perfectly fine with what others were doing, more enlightened people who were trying to be more concerned with the daily volatility. So that's the downside. Moritz and I will take these drawdowns that were sort of unnecessary.
Maybe I'll just have a quick reply, and then maybe we'll wrap this topic up, because I think we've both kind of laid out our stalls, and the listener can make up their mind. So I do agree with Jerry that in my research has found that this vol targeting does indeed improve the Sharpe ratio, but the cost of that is reduced positive skew, which is, the sort of more technical way of describing the behavior that Jerry says, where you're obviously taking lots of small losses and having bigger gains. So you end up with a system that is less kind of pure trend following in character. And it's kind of like one thing or the other. You can either say, well, I'm more interested in higher Sharpe, or I'm more interested in positive skew. There are advantages and disadvantages to those. I'll just make two very quick points in defense of my position before we wrap it up. And one is that what I'm doing doesn't necessarily introduce any more parameters, because I'm still just estimating volatility. I'm using exactly the same volatility that I used to estimate the initial trade size. So there's no additional parameter coming in there. Although I appreciate that there are ways of doing this that would result in a lot of parameters. And I'm, just like Jerry and Moritz, very concerned about having too many parameters in my system. So I appreciate the concern there, but I don't think it's an issue for me. And the second point I would make is that you don't necessarily have to leverage your system up just because your Sharpe is higher. You can kind of take that as a reward for. I don't think that's necessarily the case for me, at least. I don't really believe that you'd have to do that. You could do. I mean, theoretically, it would make sense to do that, But also, theoretically, if your system has less positive skew, that also means you should be more cautious about your leverage. So actually, the two things probably net each other off, and I wouldn't actually necessarily increase the leverage of a system just because the Sharpe was higher if the skew was going down as well. So anyway, there we go.
But I guess my point was that if you wanted to make the same 10% return or 12% return, whatever your target is, you would have to trade a little bit larger if you're cutting your profits shorter than someone like who's letting the profits run. And
yeah, I'm not actually tested to see what happens to the sort of natural standard deviation. So I'd have to sort of check to see if I agree with you there or not. You may well be correct, but anyway.
Yeah, and then just to finish it, I did want to say that it is very critical in this area to not leave out the trade level that Niels talked about earlier. And so the trade level calculation is kind of off the beaten path as well. So the way to make this work is you start with that $1 million investment, and then you trade all the trades for a long period of time based upon that $1 million. And like right now, my trade level is probably from last summer. So I have not changed. Every trade I'm doing with the same trade level. I'm probably up 30%, and I haven't incorporated any of that profit into making my new trades bigger. At some point in time, when all this open trade equity sorts itself out, and I'm no longer up 30%, but up 10 or 20 or whatever it will be, then I will incorporate that trade level, a new baseline, a new level to defend. And so this is critical. If you're every day changing your trade size based upon your mark-to-market equity, then it's much, much different. But in the opposite way, and this is 1983 Turtle 101, so I haven't changed since 1983. How bad is that? I mean, that's the opposite of evolving. So the opposite of that is to do the opposite with losing trades. So if this theoretical $1 million turns into 900,000, oh my gosh, I am changing that trade level very, very much. So I'm making it very difficult to lose money, because now if I'm down 10%, maybe I'll change my trade level to 800,000. So I'm trading very small. And so that's the kind of changes we want. When we're losing money, we're very defensive of that baseline trade level. And when we're making money, we're very slow to increase the risk, because these trades are sloshing around. They're creating all sorts of volatility and chaos, and we don't want to penalize the new trades we're putting on with this updated equity level, which is not very stable.
So yeah, just to say, I do something similar actually. So if I lose money, like at the moment, I'm in probably about 12% drawdown, 14% drawdown. So my positions are 40% smaller than they would be if I wasn't in that drawdown. And again, I don't actually increase my position once I reach my high water mark. I keep a fixed level of capital. So there's some similarities there. Maybe we should move on anyway.
Yeah, no, that's interesting. But I do want to ask something that is not specifically to any of your two different methodologies, but I do think it's an interesting topic. And it kind of comes out of what happened last year with this very sharp sell-off and this equally sharp upside reversal. Because I think, and this has sort of come up in conversations that I've listened to, but also in general in the industry, and that is, normally we all use volatility as an input in our model, and it's somewhat an important input, but usually it doesn't really matter very much how you do it, so to speak, and maybe even the look back period of your volatility isn't that critical normally. Last year, however, it could have had a big impact on your performance, partly because first it might have told you about how quickly to scale down your positions, but also it would have informed your system in terms of your future positions going forward, which may then be too small, frankly, if you're depending on what kind of volatility you were putting into your model. So I don't know if any of you have thought about these things after last year, or whether you didn't even sort of think that was an issue from the way the markets behaved last year. Rob, do you want to?
That's a really good point. I mean, I saw some research after last year's meltdown from different CTAs about how important it was to the short term, getting short and getting out of your longs back in February, March was so important. So the shorter look back periods the breakouts, for instance, were so much more important if you made a lot more money and saved money. But I don't remember seeing anyone separating out the fact that the position size on the shorts would have been dramatically impacted as well if your ATR look back was 100 days versus 10 days. That's a very good point. And so I think it's worthwhile to separate those out. I just done some updated research on the look back periods, and I looked at 10, 15, 20, 25 days. I think some people go back 100, and there's like almost no difference if you look at enough data. I did a 100-day rolling as well. There's almost no difference. If you look at enough data, it kind of all looks about the same. But yes, that's one of the problems of trend following. What I'm doing right now with my parameters makes a hell of a lot of difference with this recent short-term performance. What we're all doing with our parameters, the performance tends to be very similar if you look at enough data. And so clients are saying, why aren't you as good as Rob? And you're like, well, I don't know. I'm probably not, but you cannot pay attention to the short-term performance irrespective of anything. Yeah.
We've given our year-to-date numbers. They're certainly not asking that question right now, Jerry. That's for sure. You're doing much better than I am this year. I think Jerry's right. I think definitely clients have, in my experience, back in the day when I had to worry about them, do have an obsession with saying, well, you did what happened here in this particular month, what happened to your systems, and what are you going to do to fix it? But when you actually look over, and of course, in any given month or scenario, it's likely that some particular change to your system, whether that be changing the length of the moving averages or the look back window for your vol or something else, will make a big difference. Of course it will, but you have to look over a lot of data. And the thing you're aiming for is a system that's as robust as possible, which means it will perform reasonably well in a variety of market conditions. So when I'm looking at this particular topic, what I like to do is not look at the actual performance of my trend following system for different look back periods, but to say how well does a certain look back period do at predicting volatility going forward, because that's what the thing's for, right? The fact that it by coincidence may or may not improve your trend following performance is irrelevant. And actually, I found that improving your forecasting of volatility doesn't really help your trend following performance that much, to be honest, because it's a symmetric thing, right? So it might be that you look ahead and you say, oh, well, look, I've got this. You can even put a kind of perfect foresight into your model and say it can predict volatility 1 month forward. And that means sometimes it will see that vol in 2 weeks higher is going to spike higher because of an event the system can't know about. And it will have smaller positions as a result. Well, roughly half of those positions will be profitable and about half will be loss-making. So actually, it doesn't really make much difference to the performance of the system. So to me, it's something that people get a bit hung up on. And I have done some fairly intensive research on it just to satisfy myself that, as Jerry says, using a look-back period of, say, between about, 20 and 100 days, something like that, is pretty close. It doesn't make a lot of difference in forecasting vol. And secondly, it makes almost no difference in terms of your performance of your system. So, to me, it's one of those things not to waste your time thinking about, frankly.
Sure. Okay, good stuff. I think we've talked a lot about these things. So let's move on to another topic that came up recently. And again, maybe, Jerry, I need you to set the stage from the note you sent. And we can latch it together with the other point. But you had one point about shorts versus long, something that I know you and I talked about on Clubhouse. Maybe was it this week? Do you want to address something with Rob on that, Jerry?
I just thought we had a good discussion about shorts and the benefits. Yeah. Not sure if I've ever heard Rob talk about shorts, but I think towards the end we were talking with Mark, and I think that he started getting into maybe reasons not to do shorts or some of the other things to look at when you're doing shorts. So as this Neanderthal trend follower, I'm just like, no, you can't look at shorts individually. You can't look at sectors or longs. The whole point of the back test is that you create this large sample size of trades, one entry, one exit, a stop loss, something like that, maybe a couple of other things that you throw in there. And in order to get the sufficient sample size, or as much sample as you could possibly get, maybe it's never sufficient, you need to trade all the markets the same, and the longs and the shorts the same, and just pretend that all the trades are the same, whether they're coming from different markets and sectors, or if they're longs or shorts. And your expectation per trade is all of those. I know that if you looked at the longs only, it would be higher than the shorts, but you're not supposed to do that. And we need more sample size, not less. And we can't fine tune this. I know another thing that you said, Niels, which I didn't get a chance to talk about on Clubhouse, was I think both you and Mark were saying this, and this is something else that I don't really want to think about, and that is, commodities have different personalities and patterns. In shorts, they end violently, they end differently than longs end. Once again, I'm just going to close my eyes to all of that and say, yep, I guess that's possible. But in order to maintain the strictness of treating everything the same, all the trades, all the sectors, all the markets, longs and shorts, I'm not going to look at that data. I'm going to force myself to act like it's just all one big trade, one big way of treating all of the trades, and it's producing this sample size. So that's what I find to be very intriguing. I have over the years treated shorts differently, and I've just paid a huge price for that.
What about you, Rob?
Yeah, I mean, the reason I don't talk about shorts much is I think Jerry's in Florida and I'm in quite cold UK. It's going to be a few months before I'm wearing shorts again, that's for sure. But seriously, so this is a topic in which Jerry and I are very much on the same page, I suspect. So I do not treat shorts and longs differently. I'd make another point. It's actually worse than he says in terms of reducing your sample size, because in many markets, they've gone up more than they've gone down. I mean, if you look at the bond market, say, or the interest rate futures, the sample set I'm using, which is for about 40, 45 years now, they've probably gone up 90% of the time. So to try and do something different when they're going down, you're reducing yourself down to just 10% of your sample set. And that for me is a big concern. I'm very much of the opinion that, barring extremely strong evidence, you should do everything the same. So trade all the instruments the same, with the caveat that I do look at trading costs because I think they're predictable. So I do trade more expensive markets more slowly. But apart from that, I assume that all instruments have the same pre-cost returns for a given trading rule. I assume that longs and shorts are the same. And whenever I've gone out and looked and sort of tried to actually see if there's anything there, if you like, I've never found an effect strong enough that justifies moving away from that position. So for me, I guess I have a core value that the system should be as simple as possible. And simplicity in this case means treating everything the same. And only if there's very strong evidence can I be dragged away from it towards doing something differently. And I've never seen really, any time I've checked, that strong evidence. I mean, interestingly, at the beginning of this month, for a bit of fun, I put a poll on Twitter and said to people, what should my blog post be about this month? Because I do a blog post every month. And there were three options, and one was actually longs and shorts, but that didn't get enough votes. So I haven't done any recent research on it, but certainly every time I've looked at it, I've seen nothing that justifies me changing my position. So
yeah, and I think that things can change. Rates can go negative. Crude can go negative. We can see things we've never seen before. And one of these, I'm frequently saying the CTAs were the only ones dumb enough to stay long bonds when rates approach zero. They're the only ones dumb enough to stay long stocks, the S&P, as valuations and the bubble, over and over. Yeah, because we're just buying those breakouts. We anticipate, we can't predict. We make a lot of money on things that have never happened before. And the shorts may start to be as good as the longs one of these days. And then they're going to say, the CTAs were the only ones dumb enough to do these full short positions. How did they know? Well, we didn't know, and you didn't know either. This evidence, there is tons of evidence for lots of things. But inside our little trend-following bubble, there is no evidence except take those breakouts. Longs and shorts are the same, and they break even. That's the issue. They break even, or they make a little bit on the shorts recently, historically, in some of the sectors. So where's the downside? It's not like they're losing you tons of money, and let's figure out a way not to do them. I mean, I got destroyed last summer by not being short crude because I had a filter. Crude, heating oil, unleaded, and lots of other markets. I had a great year last year, but I wasn't really short those markets. And they ended up not being good trades anyways. And I ended up knowing that for me to make profit in those trades, I would have had to exit them discretionarily. But the pain that I suffered during that period of relative underperformance, I just said to myself, it's not worth it. So I had a better performance after that when those shorts rallied and Moritz was still short the crude. Over and over, he would just talk about this all the time, still short, still short. I'm like, oh God, I mean, I would be too. But I would rather suffer that every day, those small little losses of those shorts reversing than that huge underperformance that I had in that period. And it's not the only time that it's happened to me. So that's another thing too, is that, well, Jerry, you're talking about open trade equity. You're talking about daily performance. I thought you didn't care about it. No, it's not that I don't care. I don't like it, especially when I'm violating core principles and rules. And I'm not going to bring it upon myself, this lack of performance.
Yeah. One more really quick point, which is to point out the reason why people buy CTAs. They don't put all their money into a CTA. They've probably got a portfolio of stocks and bonds, and they're buying that CTA for diversification. And if you take out the short positions in CTAs, that's going to mean that when the stock market's going down, you're going to be flat, and you're going to basically increase your average correlation with stocks and bonds, and reduce the diversification properties that people are buying you for. So I can sort of see some sympathy in having a long bias if all of your money's in a CTA. But if it's along with another portfolio of sort of long only assets, then it's crazy to get rid of that sort of entire, almost, you're cutting off almost the entire reason why people invest in CTAs in the first place. So, for that reason alone, if an investor says to you, well, how can we trade the shorts? They're not profitable. You say, well, sorry, mate, it's a hedge for you when I'm short with stocks, right? So you should be kind of sending me a bottle of champagne every month I'm short stocks.
Yeah, and actually just before we move on to the next point, and that's actually one of the things that I think got completely missed in the conversations last year, and that is because everybody looked at that reversal on the 23rd of March, and then to some extent, you could say trend followers at that point were kind of caught on the wrong side of the trades because they were already short the equities and so on and so forth. But actually, that's exactly the positions you would want your CTA to have, even though it didn't make you money for the next 2 months or whatever. But had the central banks failed or not even shown up on the 23rd of March, that's where your protection comes from. So that's a really important point. So final point before we move on to the questions that came in. You mentioned something that you had heard or read on Hedge Nordic about classic trend versus hybrid trend following. Jerry, do you want to elaborate a little bit on that?
Well, it's really just, getting back to our conversation on closed equity and vol targeting.
Right.
And so I think there's pressure to evolve and do something different other than trend following. And there's so many smart people involved with CTAs these days that it's just inevitable. They're not going to get their degrees, understand the math, and say, oh, I did this research and I have one entry, one exit, and a stop loss. The temptation is just too great. So I don't think that you can outperform classic. I don't think hybrid is better, but everybody wants hybrid. I think they want something. Please do something. And I think when AHL and Winton and Transtrend and Aspect come along in the 90s and the 2000s and says, look at us. I know what you don't like, and I will give it to you. And this is just so obvious, and I think it's sort of free. This management of the open trades and the total portfolio volatility, it has no cost to it. And I think that is wrong. There is a cost, and there is a difference. I think it hurts profitability, robustness, and I think for CTAs, defending the initial investment plus the realized profits, the closed equity, the trade level, defending that at all cost, and I think the best metric that we could possibly have is frequently making money. I'm preserving your capital, and I'm trading systems that, yes, they have drawdowns, but the trailing 12-month return is amazing. It's the best. I couldn't find anything better. For my first 10 years in business, I made money every single year. And people were amazed by this. And I had these massive drawdowns that no one cared about. You have to be really educated and very intelligent and smart to figure out a way to say, we can do a lot better. And I did that, and my performance went in the toilet. And I finally reversed course. And that's why I'm so dedicated to promoting this sort of plain, simple, classic trend following.
Trend following plus nothing, right?
Exactly.
Yeah, so I'm not going to revisit our early discussion, obviously. I mean, people don't want to see, we were talking earlier about the big interview that's on this weekend of Harry and Meghan. So I think there's enough kind of Anglo-American conflict coming in over that without raising the heat with Jerry any more than we need to. But yeah, I mean, I have a lot of, obviously, I've got loyalty towards, the AHL. I mean, AHL pay for my house, right? I mean, it's been a few years since I've worked there, but obviously, I owe them a lot, and I like and respect them a lot. So, but yeah, I don't know. I mean, I think it's wrong to say that this stuff is for free. So Jerry's right. It's that anyone who implies that is incorrect. The way I think about risk and return is like a waterbed. You push down somewhere, it's going to pop up somewhere else. So if you are improving your Sharpe ratio, well, that's got to have a cost, and the cost, I think, is in reduced positive skew. And I found that in my research, and I'm absolutely open, and I believe that. And for me personally, I'm happy to do that, and I'm aware of that. That's a trade-off I'm making, and I'm completely fine with it. I think investors should be aware of that, of the fact that you can't just magic away risk. I think, like I said earlier, it's one of these things that's fine in limited amounts. So if you go too far down this road, you can be really in trouble. Obviously, Jerry's talked about the number of parameters. That's an issue. But also, I think the issue is that the more risk you kind of hedge away, the more likely it is you're exposed to risk you don't understand. I remember seeing someone doing some research and saying, look, I've produced this trend following portfolio, but I've hedged out all of the risk factors. I've hedged out this factor, this factor, this factor, this factor. So you're just left with pure alpha. And I thought, oh my God, I'd much rather having something with a lower Sharpe ratio, and I understand what the risks are, than having this thing, God knows what risk it's exposed to. But there will be a risk it's exposed to. But it's a risk that I no longer understand because of all this hedging, it's going to be something very, very, very subtle, and it's almost certainly going to result in a massive loss. So that's the kind of end place you don't want to end up in. Jerry and I obviously differ in how far we are between the kind of most raw and basic trend following, and he called it Neanderthal, not me, right? So that's a label he's clearly happy with. I wouldn't go as far to say that, definitely not. I'm a little bit more sophisticated, but I grant that yes, the high Sharpe ratio does come at a cost, and you should be careful of any fund that tells you that that they've completely got rid of all of these risks and it's all for free and that it's costing you nothing, because it will be introducing some kind of hidden danger into your system.
But I think also the beauty of this is that we all have maybe slightly different ways of doing things, and at the end of the day, investors need to have a few of us in their portfolio, not just one. And, that's probably a conversation for another day and a topic that I will certainly bring up at some point. Let's jump to the questions. There are 4 of those, I think, that got in. The first one is from Michael. Michael writes, I know Jerry trades breakouts and Rob trades moving average crossovers, but what are your thoughts on other trend signals? What about price versus moving average, SMA versus EMA, slope rate of change, etc.? Is there an objective reason that you prefer breakouts and moving average crossover, such as better performance, or it makes more sense, or is it one of many options that you've chosen because it suits you best? I have a feeling what Jerry's answer is going to be, but I'm not sure about you, Rob. So why don't you start?
Okay. Actually, I correct the misconception. I do actually have breakouts in my system as well. So
okay.
I've got about 6 or 7 different ways of measuring trends in my system, and I don't actually have a preference for any of them. They've got similar kind of risk weightings, so I'm actually pretty agnostic. I mean, to address some of the points the guy made, so for example, specifically simple versus exponentially weighted moving averages, there's not a lot of difference in the performance. The main difference is that the exponentially weighted moving average is smoother, which means for a system like mine, where I adjust my positions depending on the strength of the trend when they're open positions, that's important for me. That results in lower trading costs without any effect on performance. So that's a benefit specifically for the kind of system I run. If I was running a system that was just open trade stop loss, then I wouldn't be bothered about using moving average or exponential. It wouldn't make much difference. So So yeah, I'm not one to stand up and say, oh, this is better than this. I actually use a variety of things, and where I've made things slightly more complicated by, for example, using the exponentially weighted, it's to reduce costs and to make things a bit smoother rather than necessarily because I think that's infinitely superior than to say a simple moving average or a simple breakout, because I don't think that's true.
Jerry, I think we all know why you use breakout, but the question is, have you looked at other things since what you were taught?
Yes, I've looked at moving averages. I did grow up on breakouts. I like the breakouts for a couple of reasons. One is that they're harder to deal with open profits. You get a certain level of comfort with that moving average moving up every day as the market rallies. And then you look at your breakout and it's a stair step and it hasn't moved up at all. Today's massive new high in copper did not move your breakout. And so I think as human nature goes, we'd much prefer the moving average that moves up and locks in that profit. You feel so good about locking that in. Thus, I'm going to be perverse and choose the breakout. Another thing, too, is that I grew up on these breakouts and selling the lows and buying the highs. And sometimes in the moving averages, you're not selling the low. You're not buying the high. And that just freaks me out. I can't do that. I mean, no. I'm not going to. Moving average has this funky calculation. And as the market has rallied a little bit off the lows, now I'm going to go short. I can't pull the trigger on that idea. And then I think Moritz was talking about the momentum. Is it there like the 12-month look back? That can give off some crazy buys and sells as well. So as much as I pride myself on being, in every walk of my life, of being very open-minded and curious and willing to change in an instant if I see evidence, copy other people. I spent a career of trying to copy other people, read everything that these famous traders have written or said. I have to admit that with the breakouts, I cannot change. And maybe it is due to growing up on breakouts.
Yeah, no, I think that's a great answer. Actually, I think we're going to stay on the topic a little bit because the next question is from Rene. Rene writes, first of all, thanks for your inspiring weekly podcast. Listening to it really helped me and shaped me in becoming a trend-following trader. So well done on that, Rene. After intensive testing and of trend strength indicators, which are used to determine the level of risk taken in a specific position, I'm still not really satisfied with it. Whether it is the rate of change kind of measurement or a signal to noise kind of indicator, they all have the same flaw. When a long-term range is built up and a breakout occurs, the value of these indicators are very low, even though the breakout of a long sideways range can be of high quality or a high quality setup for starting a trend. Is it possible for you to discuss, one, what type of strength measurement can be beneficial, and two, how to cope with the above mentioned flaw? Without giving any of the secret source away, of course, he writes. So thanks for the question, Rene. Rob, do you want to take that? Because I think you were kind of nodding along the way.
I was thinking, God, I hope Jerry answers this question before me. Because I suspect he's going to have far more intelligent things to say about it. But if he wants me to go first, I will. But I'd rather he went first.
I'm not sure I understand the question, but it does remind me of something that I disagreed with Rob on, I think. Since he's here, he can correct. He can tell me what he really believes. But this whole idea of, I think you said something in one of the podcasts, trading the better trades better. When it gets stronger, I add to the position, the strength of the trend. And so I don't really think that there is any such thing in my thought process of the strength of the trend. Quite the opposite. I think one of the things that you have to do to get that sample size is let in some C+ trades along with your A's and B's. So on purpose, you have to have a system that does not favor the strongest trends by some sort of measurement, an objective relative strength or whatever. But so I don't understand anything other than when my entry criteria is satisfied, I get into the trade. But I'm not really measuring strength or relative strength. For instance, gold broke out first a year, whatever ago. Then silver, platinum did nothing. Now platinum is way stronger. So this is like, I'm not paying attention to relative strength. I'm not paying attention to correlation. These things come and they go. I'm closing my eyes. I have a profit on the trade. I'm going to try to ignore it as much as I can. And oops, now platinum's stronger. And I did nothing except buy platinum when the entry criteria was satisfied. So I don't think I really understand that question or agree that all the trades are created equal if your entry criteria has been satisfied.
Yeah, so I'll quickly explain the point that Jerry raised, and then I'll try and answer the question. So, in my research, I found that, for example, if you look at the difference between two moving averages, so a moving average crossover, the wider apart those moving averages are, in other words, the stronger the trend is, the higher your expected risk-adjusted return will be from the point you're holding that trade. What that means is as a trend strengthens, you will add to the position. That's the behavior you get from sort of setting things up that way. It's kind of true up to a point, because there comes a point when actually that doesn't seem to make sense anymore. And the way I deal with that is I kind of have a cap on how much risk I'm willing to take. So I'll move to like twice my average position, and then if the trend continues to strengthen, I won't add to it anymore effectively. So that's why I do that, and it does seem to work, and the evidence is quite strong, and even accounting for things like Jerry says about sample size, which obviously concerns me as well. Now, as to the question, I'm not sure I understood it either, to be honest, which is why I was trying to throw Jerry onto the bonfire there. But
so let me just to recap the question. I mean, I think the question is very simple. I mean, what type of strength measure can be beneficial? You just described one where you look at the difference between the two moving averages. Yeah. That's one.
Okay.
And then there was this thing about the rate of change kind of measure or signal to noise, where Rene feels that when you then get a big breakout, actually what it does, it limits the size of your position. So the significance of the breakout kind of gets penalized potentially by position sizing accordingly.
Yeah, so the way I do breakouts is probably quite different from Jerry, because what I actually do is the moment something's is kind of above its sort of long-term trend, if you like, I'm already buying into it. And by the time it's reached the extreme of the price, in other words, when the breakout, quote unquote, has occurred, that's when I'd actually have a maximum position. So that's how I kind of use this notion of forecast strength in breakouts. So that's the way it seems to work, in terms of the fact that, again, if you do that, there is a relationship between how strong that forecast is and what the risk-adjusted returns are. But that's another way of saying that actually, when a price reaches a limit at which it's breaking out, well, that's the point where you're going to make the most money. So that's just another way of restating the way that Jerry trades. It's just that I'm buying in earlier because of the way my system doesn't have binary signals. It has to have a notion of something that's continuously moving. So I've kind of translated the Neanderthal way of doing breakouts into a continuous system. So that would deal with that's one way of doing it, if you like. Anything, I mean, some of the things he's talking about, they sound quite complicated and overfitted and overparameterized to me. And to me, it sounds like a classic example of looking at a trading system and saying, well, I don't like the way this behaves. How can I change it? And I'm always worried about doing that, about going down that route. So I'd be quite uncomfortable about suggesting anything, because I'm to me, it sounds a bit dodgy.
Yeah, well, and I just want to say to Rene that I actually think what Rob just said there is actually quite important, and that is, I think for most people, one of the challenges you're going to face is you're going to want to overcomplicate your system, and that in itself is really something that none of us would advocate. So trying to figure out exactly how strong is the trend, maybe that doesn't really matter. The important thing is you get into the trend and you have some simple ways of determining when that is, and kind of make a lot of the points that Jerry has made earlier, just keep it simple, really.
And I think maybe one of these days we'll get into another topic, the research process. And I think when you do a back test and you have this one entry, one exit, and a stop loss, and you look at, this is really good performance. I mean, I really like this. We have made so much money, and we're very consistent. We make money almost every year, maybe until we got past 2010, let's say. So then no, but we can do better. Let's do better. Let's look at some of those trades. Did you see these trades in this period where we lost all the profit back? And somebody is on the other shoulder should be saying, seriously? You want to mess with this? the long-term performance is not good enough, we can do so much better. And that's where trouble starts. You can't do better. I mean, you want to do better. Maybe you can do better. Maybe you can become longer term, add to diversification. Your stop losses can be a little longer term. You don't want to be chopped around so much. Maybe you could trade multiple breakouts. There's many ways to make things better that don't have any impact on robustness and sample size. So I think that's, to sum up, one of my 10 commandments of trend following.
Yeah.
Absolutely agree with you there, Jerry, definitely.
Yeah, love it. All right, let's move on to another question. This is from Doogie. First question that maybe you can quickly answer, otherwise I can, Rob. Are there any CTA funds available for average UK investors? All I can say here, Doogie, is the firm I work for, we have a UCITS fund, so that's certainly available for any UK investor. But there are, I should say, in fairness, there are quite a few UCITS funds nowadays that are CTA based. So maybe I would say 10, 15 of those. So yeah, you can easily find that.
Yeah, it's the UCITS fund is the most accessible vehicle for a retail investor to invest in this kind of thing. Yeah. I'm not 100% sure what the latest is with the whole Brexit thing and what's happening with UCITS. So that might be a wrinkle.
No change.
No change
on that. Yeah, no change on that.
Yeah, so there are, for quite a few of the leading firms, as well as Niels' firm, offer UCITS funds. So that's the route I would go down if I was to do that myself, yeah.
Do any of you trade any pairs, spreads? And if so, what are some of the key lessons learned? I'm going to just read the next couple of questions because then you can think about a joint answer, since we're already at 1 hour and 15 minutes almost. Also, why has Rob not bought into Bitcoin futures yet? They've been great for trend following. From my experience, trend following and market making returns seem to be correlated. Is this the view of the top traders? And if so, any thoughts on why such correlation exists? So a few mixed questions there. Rob, I'm going to send it to you first, since the question actually was sent to you.
Okay, so the first question was about spreads, wasn't it?
Yes.
Yeah, so at the moment, I'm not trading spreads. I have done in the past, particularly in fixed income. I'm actually planning to research and implement some spread trading systems, hopefully this year. So it's something I'm going to come back to. Things to be aware of are, obviously, there's sort of different. It's a different kind of risk. So if you're trading, say, a calendar spread in, say, crude or Eurodollar futures, something like that, you're trading two things that are very highly correlated. So you're going to be tempted to put a lot of leverage on that position to achieve a particular risk, a particular return. And obviously you need to be quite careful there, because, if those correlations drop, then you could be in serious trouble. There's a bit of potentially execution risk. So calendar spreads are a bit more straightforward, because you can just execute them. You can go to market and say, give me a price for this spread. But if you're doing something like trading, say, 2s, 5s, 10s US bonds, that's 3 separate futures contracts that you need to execute a basket of. So you've got some complexity there. So yeah, they're a nice source of diversified return, because there is a little bit of correlation between, saying, trading spreads and interest rates and trading the outrights. There is some correlation there. It's not completely undiversified, but it's definitely a source of additional performance. But yeah, you've got to be a bit careful with your risk management. So. And
the Bitcoin, Rob, you're trying to avoid that.
Yeah, I mean, the honest answer about Bitcoin futures specifically is I just don't have enough capital. So, the size of the position and the risk required just far outstrips because I'm only trading my own money nowadays. So, obviously I've been disparaging about Bitcoin as an asset class, but as Jerry said earlier, that doesn't matter. That's irrelevant. The fact is, it's an asset you can trade, and it's uncorrelated to my other assets. So in an ideal world, I would probably trade it. The only reason I don't is because of the capital requirements. And the third question
was something about correlation between market making and trend following, which I'm not entirely sure of myself.
Yeah, I don't see that at all. I mean, for starters, they're different kinds of trading. So market making is a bit more of a convergent type strategy. You're relying on the market kind of mean reverting to make profits. If the market goes into a strong trend, you're going to lose money, right? Because the market will gap and you'll be stuck holding inventory you don't want. And the other thing is, of course, the time frames are completely different. I mean, market makers operate on, nowadays, time frames of fractions of a second, whereas we're much longer term. We're into holding periods of weeks and months. So I would be surprised if there was much correlation between those two kinds of trading, and I have not seen that at all, to be honest.
Okay, I'm going to go to the next question, the final question, but I'm going to put that to Jerry first then instead. And that is from Gustavo. Gustavo writes, how do you manage to switch from one system to another in terms of trades and capital? When to stop putting trades on the old system? Do you leave open trades on of the old system, even if it means capital breach for a short period? Not entirely sure about what is meant by capital breach. So let me start with that, Jerry. Again, I kind of know what you're going to answer, I think.
I hate to be so predictable, Niels, but maybe I'm just predictable to you since we've known each other so long.
That's true.
And I definitely repeat myself over and over. I think we should do a show, podcast, or a chat, Clubhouse on Bitcoin trading, trend following, and on the spread trading. So I think what he's saying is this dilemma of I have a new, and I've done this many times over the years, I have a new system. I mean, the day you do this research and you get the results back, and the team is like, hey, we're gonna implement these new systems, and they're gonna be so amazing, and life is great, and it's just one of the best days ever. It never pans out that way, but I think he's talking about what do you do when you going to switch systems, and I think it's totally okay to realize that you're too short term. That's what I usually do. I think we're being a little too short term of this one system. Let's increase the look back, or vice versa. We're too long term. Let's decrease it. So I think you just throw those positions on. You just say, okay, here are the new positions. We've got some uncomfortable adjustments to make, reducing here, adding there. You probably just should go ahead and just throw it on and do it, and then start trading the new system as soon as possible. Back in 2007 or so, we had a major change in our look-back periods, and or something like that. Entries, we were spacing the entries out. Let's space the entries out. We think this is going to be really great. So we decided to do that. So one day I went into my research department. I said, okay, are we ready? And they're like, well, just to let you know, this is like the first quarter of 07 or something. The old systems are performing so much better this year than the new systems. Oh, really? Yeah. So do we want to... So you can see this is just silliness. And so we just kept hesitating to change anything because we were influenced by the short term. And this is what happens. As soon as you make the change, there's a cost to research. There's a cost to improvement. And that is, we're going to zig. We should have zagged. The old systems now do better. Oh my gosh. So you just don't look at what you used to trade. Implement the new stuff as soon as possible. Don't look back. Don't torture yourself.
Yeah, and I think that's the predictability that I was referring to, is just keep it simple, right? That's really the answer you would want to go with every time. So that's great. Also, there's another question here. With a non-binary system of trend following, when we get a signal to partially reduce contracts, do we apply last in, first out, or first in, first out? I think that mathematically is the same, but not sure. What is your methodology? Okay, go ahead, Rob.
Yeah, I mean, I'm the non-binary guy here, so I guess I'll take the question. I guess as far as I understand it, the only difference between these two essentially is for tax purposes. So when you actually go, if you're trading futures, when you actually go to the exchange and say, right, I want to sell a future, the exchange doesn't say to you, or your broker doesn't say to you, oh, do you mean the one you bought in March or the one you bought in April? They're completely fungible. It just takes one out of your position. Now, the tax people see that differently. The tax people will say, okay, which future are you selling? They want to know, because they want to compare the prices of those two things to calculate what your taxable profit's going to be. I'm talking about in the UK. I obviously don't know how it works in the US, but I would imagine there's some similarities, because all tax authorities have this view of things. So yeah, it's whatever the tax authority says, that's the rule you've got to follow. If the tax authority says, well, it's the one you bought first, then that's what you should do. If it's the one you bought last, then that's what you should do. And if it's something more complicated, then again, you have to do that as well. So, but in terms of actually trading, it's not really a thing. It's just selling things that you already own, and it doesn't matter, whether you're selling the last one or the first one. It's not even really a thing that exists.
The final question from Gustavo is also definitely for you then, Rob, because he talks about whether one would change the moving averages if volatility changes. So, for example, if ATR is rising, do you increase, decrease the moving average period to make it more or less sensitive? So that would be for you as well.
The short answer is no. Actually, and I don't know whether this is a coincidence, but I actually did some research on this and published it in my blog just last week. So I did actually research that, and I did find that although there was a very slight effect in that when volatility rose faster, systems seem to do a bit worse. As I said earlier, unless there's very strong evidence that I should not do the simplest thing, I'm going to stick to the simplest thing. So for me, the evidence wasn't strong enough to actually justify, say, reducing or turning off fast trend following systems when volatility is rising. And the interesting thing about that result was it was actually completely different from the kind of anecdotal experience when, say, in March last year, fast trend following seemed to do particularly well when volatility went up. But when I actually looked at it on a market-by-market basis, rather than just considering what the kind of macro level of vol was, I found the opposite effect again. So I wouldn't bother, to be honest. I don't think there's any value in introducing that kind of complexity into your system.
Sure. Great stuff. Let me quickly run through the performance where we stand so far this month on the indices, and then we'll come back to a few final thoughts. Beta 50 index up about 0.25%, and up about 3% for the year. The SocGen CTA index up 10 bips so far this month, up 1.73 for the year. SocGen Trend Index up 0.4%, up 3.25 so far this year. And by the way, I should say this is as of Thursday. I think Friday was a good day, so add a little bit to that. SocGen Short-Term Traders Index down 35 basis points for the month, down 1% so far this year. Trend Barometer finished Friday at 52, so that's indicating a good environment in general for trend followers. Now, before we talk about maybe some of the things that we've noticed this week, a good resource, something interesting, I just want to say that we do try now on Wednesdays at 1 p.m. Eastern time. We do try, as Jerry was indicating, we do try to do a session on Clubhouse. So if you follow me, if you are on Clubhouse, not everyone is on Clubhouse, Rob, for example, not yet, but if you are on Clubhouse, follow me, follow Jerry, and then you will get a notification when we create the event. And then you, if we do it, then come and ask questions, and it'll be our chance to have like a real live conversation and not just a one-way communication as we've done for years on the podcast. So we enjoy that, and we've had some good sessions so far. So by all means, when we do it, and I don't promise it'll be every week, just look for the notification. Now, interesting pieces of content, if anything, that you came across recently, Rob, anything that you want to point out?
Yeah, it's quite interesting because Jerry's trading bond ETFs, and I myself actually own a few bond ETFs in my long-only portfolio. So there's a very interesting piece that came out from the BIS, the Bank of International Settlement. It's a research paper, and it's about how bond ETFs are kind of created and redeemed, and about the basket of underlying assets that are used when that happens. And it was very interesting for me because I think we treat ETFs as a black box, as like something that just works like magically, but actually that there's a lot going on under the hood, and I think it's important to be some of the more subtle risks involved with trading these things. So yeah, I found that very interesting.
Cool. Anything on your side, Jerry?
Well, I just wanted to say that I did listen to a good podcast this week. Most of the good podcasts I listened to are yours, Niels. But I did listen to RCM, the derivative, with Wayne and Wayne's partner. Yeah. And I just wanted to say that there was some negative talk about Clubhouse. And I think Clubhouse is amazing, and I think it's great. And who would have thought that talking was better than 240 characters? But that's what it is. And when I first got on Clubhouse, I thought, oh, this is amazing. It's going to have some ups and downs, but congratulate you. I don't see that a lot of people who have a microphone and can control what's being said, podcasting or media, are going to like Clubhouse. But congratulations to you for embracing Clubhouse and making all of this so much better that we can get on there and discuss things on Wednesday and bring in lots of other people who can get on and ask us questions and challenge us and make it just so much more than a podcast only. And since Rob's not on podcast, I know he'll trust me to summarize everything he said, and I'll point out all the places he was wrong on this podcast. Rob's going to go out and buy an iPhone over the weekend.
I've got to get it before Wednesday. I've got a deadline now.
I'll have an invitation because it's invitation only, Rob. And so I will bestow an invitation on you as soon as you give me the go-ahead where you have converted over to an iPhone. So you can defend yourself properly.
Okay. All right. I look forward to that. Thanks, Jerry.
Okay, cool. Excellent. Good stuff. Yeah. And by the way, I just want to add that we do try on Clubhouse to keep our sessions to 1 hour so it doesn't just go on and on and on and you never know when it's going to finish. So come and join us most Wednesdays, 1:00 p.m. Eastern time, and just follow us and then you'll get the notification. For my particular resource this week, it wasn't really a podcast or anything like that. But there's a couple of things that I found just interesting, nothing to do really with, well, the first thing has nothing to do with trading, but it did disturb me. So I did tweet about it earlier this week. So you can go through my few tweets that I do every week and you can find this. This was a video I found, a news report about how Pfizer actually allegedly holds certain countries and governments hostage in their negotiations about vaccines, how they demand total immunity for any issues that may arise from their products and demanding government property as security for these things. I mean, it's pretty shocking if there's any truth to this. And of course, Pfizer is the company where the CEO managed to sell or, to do his option, exercise on the day where they announced that they had the vaccine ready. So that in itself, I thought was a little bit dodgy. But anyways, that was one thing I found. The other thing I found was a video on YouTube that I heard referenced. It was at a BitBlock Boom 2019 conference where a guy called Michael Bitstein Goldstein talked about Bitcoin rhetoric, which I found quote unquote interesting to say the least, not just because what it suggests about Bitcoin, but actually what I think it also does is it showcases how the world of finance has really changed and what is really driving prices nowadays on many assets. So I'll leave it at that. It was concerning, but it might be worth checking out. So anyways, and then you can make up your own mind, of course. If you haven't already left a rating and review, if you wouldn't mind, because it really helps. We got some good ones in this week as well. So always very appreciative, but we can't get enough, frankly. So if you would do that, head over to iTunes and leave a rating and review. Of course, if you liked what we are saying, that's pretty much it from Jerry, Rob, and me. Thanks so much for listening, and we look forward to being back with you next week. In the meantime, take care and be well.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.